Yo, starting a YouTube video is way harder than you think. Good morning, Primals. I'm 20 and I'm a junior in college, and I'm gonna make this a personal finance YouTube channel from the college student perspective. The reason I'm making this is because I wanted someone that was my age or around my age when I started learning about personal finance. So I didn't really see anyone that was doing that. So I want to be that person for people growing up now that want to learn a little bit more about personal finance and bettering their life. I started learning about personal finance was when I was early in high school. It was mainly through books, podcasts, and videos. All these podcasts and videos and books were written by people way older than me. So I thought I'd add my own personal flair. So I think personal finance is all about making mistakes. And so when you make mistakes early, it's better because then you can learn from your mistakes in the future and avoid making bigger mistakes.
Avoid making bigger mistakes later. You're still going to make mistakes. Also, this is not financial advice because I don't want to get sued, so please don't sue me.
All right, today we're talking about credit. We're going to dive into six different things. What is credit? Credit score ranges, loan rates, credit cards, calculation of your credit score, and how to check your credit score. First thing and most important, like what is credit? So pretty much credit's your ability to borrow money. Usually that's going to be from banks in ways like car loans and mortgages. Another way is credit cards, and that's money that you can spend on anything. So your credit score is how companies determine whether or not they're going to let you have their money. And so they're not going to give you money if they don't think you're trustworthy. So the way they test to see if you're trustworthy is through your credit score, and the higher your credit score, the more trustworthy the company thinks you are. You can build credit by having more borrowing accounts and then paying off the loans that they give you on time. These loan accounts could be like a car loan, like I said, mortgages, it could be like a student loan, credit cards, stuff like that. So your credit score ranges from 300 to 850. Again, like I said, the higher it is, the better it is. When I turned 18, I didn't have a credit score at all. And when I got my first credit card, I had a credit score of around 640. Now, 2.5 years later, I have a credit score around 750. Even with not that much time and not having access to a credit score before 18, I've still been able to build it up. It's going to help you a lot in the future with getting better loans and better loan rates. And so it opens up your world to a lot of more opportunities. And that's what it's all about. Discover is a pretty good company for people just starting off with their credit careers because they pretty much approve anyone, even if they don't have a credit history. And what they did for me, since I was just turned 18, they gave me this secured credit card. They gave me a $200 credit limit. A credit limit is how much money they are giving you to spend. So every month I have the ability to spend up to $200. And then if I pay that off, I can spend another $200. Also, you can pay off your credit card at any time. Just be mindful of that. If you reach your credit limit, you can pay it off and then spend more money on it again. Since it was a secured card, I had to give them $200 first. So the company pretty much didn't have any risk because they already had my money if I didn't pay it off. After 6 months of that, they gave me my $200 back and they increased my credit limit to, I think, $1,500. So then I was able to spend $1,500 and they had a little bit more risk because they didn't have my money anymore. They did this because my credit score increased and they knew they could trust me. That's how companies determine whether or not they're going to be able to give you loans or credit cards. Let's use an example that you guys can probably grasp more easily. So say you want to get a new car or a used car, which what I'd recommend. I have a 2011 Toyota Prius, pretty sick. I call it the Silver Bullet. So what I looked up just now is the average used car loan is around $26,000 in the US, and the length of the loan is usually 67 months. So as we can see from this chart, if you have a really good credit score, you're only going to be paying around 7.4% interest, which is actually a lot, but that fluctuates based on the Fed and like what the government's doing. But that's a whole nother video, and I'll explain to that later. Where I started, I would have gone around 14%. So that's about double the interest rate. Which doesn't seem like a lot, like having 7% versus 14%, but over the course of this loan, it's going to make a big difference. Here's the first example. I used loancalculator.net. I'll put the link in the description to all the resources I use at the end of the video. Here's a loan amount, the average used car loan, and then the loan length, and then the interest rate. And so as you can see on the right, you're going to end up paying around $32,000 over the course of those 5 years, 7 months. And the total interest you're going to be paying is around $5,800. So that means that 18% of the money you paid isn't going towards the car at all. That's just going to the bank that lent you the money to buy the car. So let's see how this affects if you have a low credit score. So if you have a low credit score, again, same loan amount, same loan length. The only thing that changes is the interest rate. And now we can see that you're going to be end up paying $37,800 and 11,700 of that is going to be towards interest. So that means 31% of the money that you're paying towards this car is going to the bank. That's a lot of money. That's going to be $5,800 difference that you could have saved by just having a higher credit score. So that's why one of the reasons why having a high credit score is important, because not only will you be more likely to get approved for this car loan, but you'll also be end up paying way less money over the course of the loan. Now let's dive into credit cards. It's one of the best ways to build your credit. Credit cards are pretty much you borrowing money. You have to pay this money back because you're giving it to this company. And I'll explain a little bit about why you have to pay this money back. First, these companies will hound you and will make your life miserable and will like make you not able to do anything. So if you don't pay them back, you won't be able to get any other loans. You won't be able to get a mortgage. You won't be able to do anything. So you won't ever be able to buy a house. You'll be like stuck with a limited amount of options. So that's never good.
It's a slight exaggeration, but you get the point.
If you don't pay off your credit card, you're going to have really high interest rates. So that's going to be 20 to 28% annually. And as you saw with the card, that was a 14% interest rate for the high one. So imagine how much more money you're going to have to be paying in interest just for not paying on time. But if you use this properly, you'll be able to build credit and it can actually be a really helpful tool.
Just to clarify, if you pay your card off on time, you're not going to have to pay any interest.
When you apply to a credit cards, the credit card companies are going to ask you for a lot of different things. First, they're going to ask how much money you make. This is like how much money you have available to yourself. So, say you only work over the summer, you make $10,000, you can put $10,000 as the amount. Also, $10,000 for the summer, it seems like a lot. Anyways, whatever. Put the amount of money you make in a year, but you can also put in the amount of money you have available to you. So that means if your parents put money into your account, or if your friends put money into your account, or you have a side hustle or something, you can also add that to the amount. So say you have $10,000, but you have access to another $20,000, you can put $30,000 as the amount of money that you make in a year. They're also going to ask you for how much your rent is. Then after you put all this information in, you also have to put your social security number in. So make sure, again, this is a trusted company that you're giving your information to. They're gonna run everything and they're gonna see if you're approved or not. Usually this only takes 5 to 10 minutes. Three ways that you can get rewards from credit cards besides building your credit. The first one is a sign-up bonus. So you can get sign-up bonuses because credit card companies always want new customers. So they're going to incentivize you to get their credit card over other credit cards. Also, credit card companies are always for their own best interest, like they're not trying to help you out. So just be mindful of that. They're trying to make money off of you. So you got to use your card responsibly to get all the benefits you can from it. One of the credit cards I got, actually the Quicksilver card, if I spent $500 in the first 3 months, they gave me a $200 bonus back. First $500 I spent, they gave me $200. I only had to pay $300 for my first credit card bill. So that was pretty cool. Another way they incentivize you is with cash back. So that just means if this Quicksilver card has 1.5% cash back, it means every $100 I spend, they give you a $1.50 in rewards that you can use towards your next statement. That saves you a little bit money, and that's why one of the reasons why I use credit cards for most of my purchases instead of a debit card is because I can get some money back on every purchase I make. Another one that I haven't really dived into is travel points. Those are like pretty much every dollar you spend, you get a certain amount of points, and then you can convert these points into like booking hotel rooms or getting flights and stuff like that. That generally requires you to spend more money. So I wouldn't recommend it for someone that's just starting out. I don't even have any cards that have travel points because it's not really worth it for me at this point. Once you do decide to get a credit card, I would recommend you create a spreadsheet where you can track all the credit cards you have and a lot of important information about each card. I'm actually going to give you guys a template in the description that you guys can use to be able to track this easily. Here's what I do. So I'll describe to you a little bit about how it works. So first I put the name of the credit card. So that's just like which credit card company I use that from. Pretty self-explanatory. Then I put when I open the credit card, just so I can keep track of how often I open them and I can make sure that I'm not opening them too often. Then I have my credit limit, which is the amount of money that I can use at any given time at this credit card. You never want to use the entire amount that they give you. You usually want to keep that around 30% or lower because, as I'll talk about later, that's how your credit score is calculated. Another more advanced thing is your credit limit, last credit limit increase. So that's every 6 months or so, you can call your credit card company and be like, all right, hey, I'm pretty responsible with using this credit card. I know what I'm doing. Can you please increase my credit limit? Most of the time, if you've been paying it off and you ask them nicely, they'll give you the credit limit increase, and that just means that your credit utilization rate will go down. And so your credit utilization rate is the percentage of your credit limit that you're using. And so again, you want to keep that below 30%. And what's really important with every credit card that you open is that you set up auto pay for it. On my spreadsheet, I have attached what bank account I set up auto pay for this credit card. Pretty much all of my credit card accounts I have connected to my checking account. So what this means is that after every month, my credit card will just pay off from my checking account. So auto pay is really important because then you'll never forget to pay off a credit card bill. Another category I have is the annual fee. So none of my cards have an annual fee right now. More advanced cards will have an annual fee, but you shouldn't really worry about that when you're just starting out because it's not really worth it. Another thing that credit card companies do is they give you referral bonuses for recommending your friends or family to credit cards. Again, credit cards can be dangerous for some people that don't take care of their money properly because you want to treat your credit card as if it was money you're spending right now. It's difficult to do so because you don't see the money coming out of your bank account all at once. You only see it coming out at the end of the month when you pay off your credit card bill. So you got to make sure that you're treating your money like it is a debit card and like the money's coming out of your account. So you never spend too much on something that you can't afford. And then all the way on the right of my spreadsheet, I have the perks that I can get for each credit card. So I actually color coded this. In green is the ones that I use most often because they have the best rewards for the things that I'm using right now. Say I go out shopping and I use Apple Pay with my Apple Card, I'm gonna get 2% cash back. If you guys would like, I can go into depth into why I got each credit card in another video, but I don't want to make this video too long. How is your credit score calculated? So 30% of your credit score is going to be calculated based on the amounts you owe. So that's going to be directly impacted by your credit utilization rate. That's just the total amount that credit card company says, all right, we'll give you $1,000 divided by the amount you actually spent. So say you spend $100 and they give you $1,000, you're only using 10% of your credit limit. So that's your credit utilization. You want to keep that below 30% for you to be able to increase your credit score as quickly as possible. This means that you don't need to, if they give you $1,000, it doesn't mean you can't spend more than $300 on the card. It just means once you get to $300, you should pay it off and then you can start over. Then 35%, the most important thing on calculating your credit score and having a good credit score is keeping your payment history good. So that means pay off your credit card at the end of every month or at the end of every statement period. You need to pay it off after every month. Otherwise, they're going to charge you interest and your credit score is going to drop. Credit mix just means the different types of loans that you have. So that could be student loans, car loans, mortgages, credit cards. The more variety you have, the more points you'll get for that. But again, that's not a really important part of your credit score. It's only 10%. So if you only stick with credit cards, you should be fine. 15% is length of credit history. So this just means that the longer you have your loan accounts open for, or like your credit cards open for, the higher your credit score is going to get over time. And so you want to open these accounts as early as possible and you don't want to close them out. Otherwise, your credit history will decrease because they'll just take an average of all of your accounts. And then 10% is new credit. That just means new credit cards that you get or new loans that you get in general. So I told you all this information, but how do you actually check your credit score? I'd recommend opening an account with Credit Karma, signing up and checking your credit score is free, and you can do it at any time. It'll update more or less once a month. When you sign up for this Credit Karma, they will ask you for your social security number. So be careful when you're giving out your social security number because that's very important. And if you give it to the wrong people, they could kind of ruin your life by just like opening a bunch of loans on your name. General recap, you want to start early with credit so you can get a car loan, you can get a mortgage, you can get all these different things at low rates. Remember our car example? Imagine if that applied to a house. Imagine how much more money you'd be paying if you had a low credit score versus a high credit score when you're paying for a house. Always pay on time. You never want to miss a payment because then you're going to lower your credit score and you're going to have to pay a lot of money on fees to these credit card companies. And they're already rich enough. You don't need to give them more money. Another thing that's important is do not open credit cards too often. So every time you open a credit card, the credit card company is going to create a hard inquiry, which just means they're going to check what your credit score is. For some reason, I don't really know why, that will lower your credit score. That's pretty much just a temporary thing. Over time, it's going to go back to normal, but make sure when you're applying to like a big loan, like a car loan or a mortgage, you're not going to want to have many hard inquiries recently. Otherwise, it could lower your score and you can get a way higher interest rate, which again is bad. You want to aim for opening a credit card once every 6 months or so, maybe even once a year. But don't go crazy on trying to apply to a bunch of different credit cards because even if you don't get the credit card, they will still give you a hard inquiry and it can still lower your score even though you didn't get the card. Before you apply to credit cards, you want to check on NerdWallet. I think it's a trusted website. You can check to see what the ranges of credit that the typical card holder gets for that specific credit card. So say I want to apply for like the Amex Platinum card. It's going to say the typical customer that gets this card has a credit score like an 800 credit score. So if you have a below 800 credit score, you need to be a little more careful because you're probably not going to get this card and it's going to ding your credit score. Again, be very careful with your social security number. You don't want to be giving it out to anyone. Just make sure the company's trusted. So ask your parents, ask Google, whatever. One of the things you can do if you're not 18 yet is you can have your parents add you to their credit card as an authorized user. And this just means that if they keep making payments on time on their credit card, you will pretty much get the benefits of them paying off their cards. If they have a good credit score, just ask them to join as an authorized user and you can start building your credit even before you're 18. My parents didn't do that for me. And so when I started out, I had to start out from scratch when I was 18, but I told my parents to add my sister as an authorized user. Now she has been building credit for 2 years and she's not even 18 yet. But I'm pretty sure that when she turns 18 and she's able to open her first credit card,
She'll have a 700 credit score.
when you ask your parents to add you as an authorized user, that doesn't mean they have to give you a credit card. You always want to double check any information people give you. So check in with your parents, do Google searches, check with other people that other YouTube videos, read books, listen to podcasts. I will make a video in the future about all the resources that I use to learn about this information. I'll talk about them and why I like them and why I didn't like them or whatever. All the resources are in the description, and I really hope you enjoyed and were able to learn something. Please leave a comment with things you'd like to see in the future.